Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 177 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you into our world of financial markets and financial planning. So good afternoon, Matt.
Good afternoon, Mark. We got U.S. playing in the World Cup. Nick Whitaker, Director of Research, reminding us that it's about 27 minutes.
2 o'clock. 2 o'clock, yeah.
Excited for that. We got a lot of big college games this week.
Yeah, especially the big one in our neck of the woods here in the Midwest is obviously Ohio State, Michigan.
Yep.
Both who got tested pretty good this past weekend. I think Michigan only won by a last-second field goal, and Ohio State was tested by Maryland. But two undefeated teams going into arguably the biggest game of the year. So that's going to be interesting.
It's the way I want it.
Who do you got?
OSU, because I'm in Ohio here, baby. So
yeah,
absolutely.
Let's see what the point spread is on this game.
That should be interesting.
Take a guess.
I'm going to guess OSU by 2.5.
Let's see.
OSU by 2.5 is the guess.
As it stands right now, OSU by 7.5. That's a lot of points for that close of a game with two teams that are, as of right now, in the top four.
Is that what home field advantage is worth these days?
I guess so. Interesting. Yeah. So, it's gonna be a fun weekend. I'm sure everyone's looking forward to the shortened holiday week and shortened trading week.
Yeah, I mean, going back to trading and what we do for a living, the market's closed on, of course, Thanksgiving, half day on Friday, closes at 1 p.m. Eastern time.
Yep. So looking forward to another good week, and hope everyone enjoys time with family and friends for Thanksgiving.
Absolutely.
So before we begin, Matt, as always, just want to take the first few minutes to recap the performance for the month and the year of the major indexes that we track, and these numbers are as of the market close on November 18th. S&P 500 index is up 2.4% for the month and down 16.8% for the year. Dow Jones Industrial Average up 3.1% for the month, down 7.1% for the year. NASDAQ Composite Index up 1.4% for the month and down 28.8% for the year. The Russell 2000 Small Cap Index up marginally 0.2% for the month and down 17.5% for the year. And then finally, the Vanguard All World ex United States ETF up 9.5% for the month and down 18% for the year. The 3-month Treasury rate at 4.34%, the 2-year Treasury rate sitting at 4.5%, and the 10-year Treasury rate at 3.82%. So moving right along, Matt, to big headlines and current events. Pretty good positive producer price index data, also known as PPI, that came out here recently following the CPI, or Consumer Price Index, report a few weeks ago that was very good, came in lower than expected, and the same thing happened with the Producer Price Index. So for the month of October, we just got those numbers for October, and October core PPI month over month was flat, and it was estimated to increase by 0.3%.
That's huge.
That's massive. That's massive. The October core PPI year over year is up 6.7%, but it was estimated to be 7.2%. And then the regular PPI month over month was up 0.2%. The estimate was 0.4%. And the year over year PPI was 8% when the estimates were 8.3%. So pretty good numbers there. Do you want to just give a brief 30-second overview of what the PPI is, Matt?
Yeah, so the government does two calculations on inflation every month. One is going to be the Consumer Price Index, which we previewed 2 weeks ago in podcast 175. You and I held the call the day before that number came out, and that's going to measure inflation on a consumer level. The PPI does it on a industrial or manufacturing level. So, who's actually making the goods? What are they experiencing as they try to pass that on to the consumer? And
Right.
so, we are seeing it at the source, at the production source. We're seeing inflation come in too. And I can't say this strong enough. I said it pretty strong on podcast 175, the day before CPI came out. I am spiking the football on this, that, don't be surprised if this information comes in a lot softer than people are expecting. And it caught the market off guard. We had a phenomenal day that Thursday when that news came out. Two most important dates. I'm going to throw it out there right now. The rest of the year, December 13th, we're getting CPI data for November. The very next day on the 14th, we got the Fed announcement. That is the Super Bowl for the market in those 2 days.
Yeah, absolutely. And definitely going to dictate, I feel like, what things are going to be like over the next month or 2 months to start the new year. So that's going to be, very important month this year in December.
Yep.
And then finally, obviously that's been, very heavily talked about in the mainstream media is the FTX blow up. And we can talk about, we can talk about this for days, so we'll try to keep it short and sweet here. And this kind of leads me into my first research from this past week. And it was a blog post from Brian G's Alpha Charts blog titled, "What is Going On with FTX?" So 2 weeks ago, Matt, hold on. FTX was a cryptocurrency exchange where, people could go buy or sell different cryptocurrencies, different tokens, different coins, and was widely known, right? They had a lot of sponsored athletes, for example, like Tom Brady doing Super Bowl commercials. I think FTX Arena was where the Heat played. So, I'm talking about a pretty well-known big company, and what people thought was that they were the premier company where people would go and trade cryptocurrencies. And, there was a lot of trust and faith put into the founder and the company. And, we had this story blow up just about 2 weeks ago. So it was the downfall of FTX 2 weeks ago, and it was once the second largest crypto exchange. And again, this was all over the financial news. And we're still getting information, Matt, and the story is still unfolding, but accusations are that the FTX founder, Sam Bankman-Fried, used customer funds held on the FTX exchange to cover losses in his hedge fund, which was called Alameda. So pretty shady stuff going on right there.
We live in a world of segregation of client assets. Right.
Crypto
is still in a world of commingled client assets.
Exactly.
I'll let you continue.
Yeah. And I think, this is arguably, I think, the biggest scam going back to Bernie Madoff. Right. And it was kind of the same situation. There wasn't a third party intermediary acting as a custodian, and you had, client funds literally going into Madoff's bank account. Kind of a similar story here. So the downfall started 3 Sundays ago when Binance, which is another crypto exchange, was going to acquire FTX, but decided against it because of the recent revelations that had come to light about FTX. But Binance didn't really give any details, but this got other crypto exchanges scrambling to provide what we call proof of reserves to prevent a run on their exchanges. So if, people get for example, a simplistic example is, that Chase Bank had, a quarter of the customer deposits that they should because they invested the other or lent the other portion of the deposits out, people would start to get nervous and be like, hey, I'm going to go take my money out of Chase while I still can before other people do, and there's no money left.
Quote unquote, running the bank.
Right, exactly. So on Friday morning, this was November 11th, FTX and 134 of its companies declared bankruptcy.
134 within itself is a little nuts.
That's crazy. And FTX went from being valued at 0 to 32 billion and then back to 0 in just 3 years. It has over 100,000 creditors and between 10 and 50 billion in liabilities.
How is it that wide?
It's crazy, man. And among its investors were Sequoia Capital, a big player in the industry.
Big private equity firm too.
Yep. Unfortunately, on an Ontario teachers pension plan, however, I think it was only 0.9% of the pension plan was invested, but nonetheless, Tom Brady and the family offices of Jack Dorsey and
founder
Mark
Twitter,
Zuckerberg,
founder of Facebook.
Yep. And if the story wasn't strange enough, 600 million in funds began moving from FTX crypto wallets mysteriously, like right after this story broke. And it's been reported as a hack, but I don't really think anyone knows what's going on. And with all this going on, the founder, Sam Bankman-Fried, was denying rumors that he had run off to Argentina. So there's a lot that went into this story, and there's a lot of stuff going on. People were very confused, as they should be. But let me give you a couple minutes here to provide your thoughts on this, Matt, because there's a lot of people that lost a lot of money here, and it's not something I think to take lightly. I mean, me and you can sit here and be like, oh, you could have seen this coming with crypto, but this is why it's kind of like the wild west in crypto land right now, and how me and you by law really aren't required to, aren't able to provide advice on this stuff, because it's really still in its infancy.
Yeah,
like we're in the first. We're throwing warm-ups before the first inning.
Yeah, I mean, there's no real government regulation on this stuff yet, which is why when you and I are dealing with people's life savings and retirement, you can't invest in that type of stuff when there's no regulation on it yet. I mean, but I think ultimately, here's where I stand on this. This is not, for me, a crypto issue, like the actual, the big players like Bitcoin and Ethereum. This is an exchange issue. And I think what this is going to do is, once you see adoption and custodian of these large custodians like Fidelity, NFS, Schwab, Pershing, TD Ameritrade, these larger institutions that are highly ethical, segregate client assets. And what's going to happen is you're going to see people want to use and house their crypto at those exchanges rather than the ones that you see right now, like Binance and FTX and Crypto.com and et cetera. And I'm not recommending for or against those names I just mentioned, but rather, I think people will look at it and say, well, if they're going to commingle client assets, I would even pay a little bit to have a custodian at a manager that segregates mine than one that doesn't. Right. And I think that's where the puck is going. This is, to me, not a crypto issue. This is an exchange issue. And the world that you and I live in
issue, right?
Yeah, I mean, the world that you and I live in with securities, i.e. stocks, bonds, ETFs, etc. We've been living in this world for a long time. Crypto, as you said, is in the wild west infancy stage. And now they're starting to learn really hard lessons. Oh, segregation of client assets, that's an important one. I got to remember that next time. Right. And it's not me saying that from afar, but rather these are the things that you and I have to think about when we are dealing with other people's money. Right. And in people that are kind of doing it on their own, they have to learn those lessons, unfortunately. And this is unfortunately one of those. I mean, there are people that, sold everything to invest their money into cryptocurrencies. There are people, I've heard stories that's accurate. And it's just a sad situation. But this stuff happens, right? There's been, there's been books written on all of the financial, scams that have gone on, since inception. And this one is probably gonna be at the top of the list. But it's really going to be interesting to see how this all plays out, Matt, because, the theory behind, crypto and the blockchain is that it's all decentralized, right? So you don't have to depend on an institution or it's not meant to be regulated. Right, exactly. It's not meant to be regulated. So I just think it's going to be really interesting how this is all going to play out. And obviously this has been something
it's been talked about deeply, in Congress and through the government. But I think this is even going to provide a more eyes on it, that the regulations, when they do come out, which I think they will be pretty substantial. And I don't want to get into politics, but he also had donated significant amount of money, the owner, to different people in Congress.
I heard he was
upwards of 40 million.
I heard he was either a number 3 Democratic donor for the last midterm election, number 3 in the country.
So that doesn't look good either, obviously. But
yeah, I think where I'd put a bow on this conversation, this is a custody issue. This is not a crypto issue, in my opinion.
Yeah, I agree. Second thing I had was a tweet by Tom McEvily on November 5th. And we'll have Jenna throw this chart and tweet up for everybody here on the YouTube video if you're watching, or you can check it out at our show notes at Jessup Wealth on Twitter or Jessup Wealth Management on LinkedIn and Facebook. But Tom says, this has all been said before by lots of smart people, but it's worth repeating. Inverted yield curve episodes are followed by rising unemployment 100% of the time. So what this chart shows, Matt, is that the red line is the yield curve of the 10-year U.S. Treasury note and the 1-year T-note.
Yep.
And it takes, the 10-year yield minus the 1-year yield. And again, in a normal environment, people would expect that the 10-year yield would be higher than the 1-year yield because there's more time for, risk or uncertainty, black swan events to happen in a 10-year time period than a 1-year time period. And again, we've talked about yield curves and inversions and what that means. But when the 1-year T-note is yielding more than the 10-year, then that's indicative of an environment that's not normal. There's stress in the system, and that people are pricing in more risk in the next year than they are over the next 10 years, which is, we know, are not normal. But what this chart shows in the black line then is the unemployment rate. And virtually, it looks pretty 100% accurate to me that once we get a yield curve inversion of the 10-year and the 1-year, unemployment tends to rise pretty soon after that. And I think, we've been talking about this for some time now, and people have been like, hey, we're not in a recession right now because unemployment, we're still virtually at full employment. But I do think over the next several months, over the next 6 to 10 months, you are going to see a spike in unemployment. I just have no reason to believe that this time would be any different. And we've already talked about the layoffs at the big tech companies and, engineering firms across the country. So again, just wanted to highlight this for people that, I would expect some more poor economic data, especially on the unemployment front, over the next several months. And it could be coming, sooner than people think.
Absolutely. With what the Fed's doing has consequences. They know that. They got the dual mandate, 2% or less on inflation, annual inflation, full employment, and they are putting aside the full employment to get inflation under control. What's the collateral damage?
Right. Eventually they're going to have to deal with it, but they don't want to deal with it right now.
That'll be the secondary thing. I feel very strong that unemployment's going to go up. But I would argue that a lot of stocks in the economy's, the stock market, I would say, has priced that in, and things in Main Street America are going to get worse before they get better. We've said that, and this is just another proof that that's going to happen. Yeah,
absolutely. Last thing I had, Matt, is another hot button issue for a lot of people right now that has been circulated in the media. It's an article from the Wall Street Journal on October 11th titled "Federal Officials Trade Stock in Companies Their Agencies Oversee."
Shocker.
So I thought this was interesting, Matt, because at the conference we were at a couple of weeks ago, we had a gentleman talk from Fidelity who there was a question asked about what he thought about, what he thought about, Congress men and women being able to trade stocks in, companies that their department oversees. And we can get into that and what we think the answer is here, but I just wanted to read a little bit from this article, Matt. We started off by saying thousands of officials across the government's executive branch reported owning or trading stocks that stood to rise or fall with decisions their agencies made. More than 2,600 officials at agencies from the Commerce Department to the Treasury Department during both Republican and Democratic administrations disclosed stock investments in companies while those same companies were lobbying their agencies for favorable policies. That amounts to more than 1 in 5 senior federal employees across 50 federal agencies reviewed by the Journal. A top official at the Environmental Protection Agency reported purchases of oil and gas stocks. The Food and Drug Administration improperly let an official own dozens of food and drug stocks on its no-buy list. A Defense Department official bought stock in a defense company 5 times before it won new business with the Pentagon. That's insane. While the government was ramping up scrutiny of big technology companies, more than 1,800 federal officials reported owning or trading at least one of the 4 major tech stocks: Facebook, Google, Apple, and Amazon. More than 6 officials at 5 agencies, including the Federal Trade Commission and the Justice Department, reported trading stock in companies shortly before their departments announced enforcement actions such as charges and settlements against those companies. More than 200 senior EPA officials, nearly 1 in 3, reported investments in companies that were lobbying the agency. EPA employees and their family members collectively owned between 400,000 and nearly 2 million in shares of oil and gas companies on average each year between 2016 and 2021. At the Defense Department, officials in the Office of the Secretary reported collectively owning between 1.2 and 3.4 million of stock in aerospace and defense companies on average each year, examined by the Journal. Some held stock in Chinese companies while the U.S. was considering blacklisting the companies. About 70 federal officials reported using riskier financial techniques such as short selling and options trading, with some individual trades valued between 5 and 25 million. In all, the forms revealed that more than 90,000 trades of stocks during the 6-year period occurred. Finally, when financial holdings caused a conflict, the agencies sometimes simply waived the rules. In most instances identified by the Journal, ethics officials certified that employees had complied with the rules, which have several exemptions that allow officials to hold stocks that conflict with their agency's work. So, my takeaway from this article, Matt, and from what I know about it, is there are rules about this stuff, but they're just not enforced and they're not followed. They're just waived. And I think this is, something that is really kind of disturbing, because you have politicians all the time being rah-rah about certain industries, and just picking one, for example, not to favor Democrats or Republicans, but obviously like big oil, right? And energy in this country and the push towards green energy. But you have people at the EPA that are buying up oil and gas stocks. Or, an even better example is the defense company. Publicly traded defense companies win contracts with the Pentagon all the time. And literally, if that's not the definition of insider trading, buying a defense company before an announcement of a contract was signed, I don't know what is. Thoughts?
This is a tough one for me, because you and I live in such a highly regulated world that for us, we just live in such high regulation that when you see others, quote unquote, not playing by the same rules, it just feels very unfair.
Yeah, it does. And people are pissed. People are pissed off.
I mean, that's just kind of the angle I come at. Again, you and I are just used to living in a highly regulated world. Entities such as the Securities and Exchange Commission, and when others have similar rules and don't play by them, that's obviously there needs to be some change there, right?
Right. And everyone's like, well, should government officials be prohibited from trading individual stocks? And I don't know if it's necessarily to go that far. I think that people should be able to trade in what they want, but if you're trading based on inside information that the public doesn't have, then that's obviously an issue. And again, it sounds like there's rules in place, they're just not being followed. So
to me, this is not tough. You either invest the money in a blind trust. So when you're president of the United States, right, your money is in a blind trust, meaning, you kind of specify how aggressive or conservative, but you're not making the day-to-day decisions on that investment. And I think a lot of these higher officials need to have something similar, or it needs to be at a custodian to where they will not allow those trades unless it's written signed off by compliance, or whoever, the ethics officials are. They certify, okay, Mark's able to place that trade.
Right.
It's not that hard. It's no different from an insider of a company, right? That insider of the company has to run that trade by an ethics committee or compliance. It's not that hard. The infrastructure's already there.
Or if they want to keep doing it, because who in Congress is gonna vote to have stricter policies or stricter punishments for these things not being,
Well, yeah, this is the same entity that votes their own raises.
Right, exactly. So, or have it where that day or the day after you place that trade, you have to disclose that like within 24 hours of placing that trade, so that everybody else can be like, oh, so-and-so congressman or woman just took a big position in a huge defense company that oversees that part of the government.
It should be instantaneous.
It's wild. It's wild to me. So that's gonna be interesting to see how that plays out over the next couple of years, because there's eyes on it now, and there's people on Twitter, and there's services out there that you could subscribe and pay for to follow what different congressmen and women are doing in their trading accounts.
We talk about it once in a while on our investment committee, don't
we? Yeah, exactly. And somehow, Matt, some way, a lot of these men and women have better track records than some pretty legendary professionals in our industry. So
I wonder how that is, Mark.
I'm sure nothing's going on, though, right?
That's interesting.
Turn it over to you.
I got 3 good ones this week. I'm going to start with a little bit of a Debbie Downer. All right.
And then you're gonna bring us back.
All right, then I'm going to bring you back. I'm going to start you low, and I'm going to bring you back. So here we go. First one, lending standards are getting tighter. This is according to top-down charts on November 13th. Jenna's going to put up this chart. It's going to show tighter lending standards this says will, tighter lending standards could weigh on profit growth. This is according to top-down charts. Bank loan officers have a greater chance of saying no right now. Now, this is from top-down charts. I talked about this the other day with regards to commercial real estate. Banks are starting to tighten up their criteria and conditions, Mark, by which they make lending decisions and reporting weaker demand for loans. This is typically what you see in a downturn. Shocker.
Right. You shouldn't be surprised by this, right? Because there's been things put in place after 2008 to make sure they're not lending to people that aren't going to be able to pay the money back, right?
Absolutely. The days of the walking in and telling the loan officer, we had Matt Edwards on in the past. Oh, hey, my income's $200,000, and there's no proof of your income.
Right.
That's not happening.
No, those days are gone.
You can see on the chart that normally profit growth decreases when lending standards are tighter. Not shocked by this. But again, here's what I want to challenge the narrative right now in the market. When you look at valuations, you look at what people are expecting earnings within the S&P to really come down next year, I question that. And so I just want to throw this out there. I think the market is overly pricing in a worst case scenario for overall profitability going down than what might actually take place. I just want to throw that out there, that the market's pricing in a lot of doom and gloom in the form of a drop in earnings next year.
Yeah, I think so too. And it's funny you say that. I was reading a piece from Bespoke that you shared with me, and it talks about the same thing. I mean, I think the beat rate is still hovering in like the mid 60% right now, and I think people can make the argument that it should be lower than that with how much damage has been done in the stock market. And I'm sure there will be a slowdown to a certain extent, right? But like you said, right now people are still spending money, and I don't see a huge deterioration. Again, I see a slowdown, but I don't think it's going to be this, drastic loss of profitability that everybody has been rah-rahing on mainstream financial news media.
Agreed. My next thing is raw economic data is indicating a slowdown. So this is a tweet by the founder of FreightWaves, Craig Fuller, on November 15th. FreightWaves is a supply chain data analytics firm. Okay. So Jenna's going to put up this chart that he posted on November 15th. And the quote on the tweet says, truckload spot rates have dropped to a new cycle low, down from $1.61 a mile, down to $1.61 a mile from $1.86 a mile a month ago. That's a 13% drop in the past month. So this is normally the time of the year when, say, retailers, when they get low on inventory, they need it yesterday, Mark. And usually the spot rate of the demand for calling up a trucking company and saying, I need this truck to be here and I need to get that truck to point B and you're going to pay top dollar, it's depressed. And I think that goes to show you the supply chains have gotten a lot better than it were during COVID. And I think it goes to show you that with what the Fed is doing, it's bringing in inflation. This is one of these data. So when the data comes out for December or the data comes out for January and February and it shows inflation coming in, remember these conversations. The raw data like this is telling you it's happening. It should not be a surprise to the market, but most market participants have this stuck in their head. Inflation's going to be really sticky. It's going to be really sticky. I'm not seeing it in the raw data. And I want to throw it out there. I think the data is going to continue to soften the next couple of months. Don't be surprised when you see it.
Yeah, no, absolutely. Yeah, it's been pretty crazy to see the price drops in, trucking rates, shipping rates, all across the world since COVID, because you had this huge spike, but now we're coming back to planet Earth here.
Yeah, and I'll finalize. He actually had this as a subtweet to this. Craig said, quote, tender rejections. That's a measure of the percentage of contracted truckloads that companies turn down have dropped to below 4%, a new cycle low. So in essence, any business these guys and gals can get, they're saying yes to. And some comments were alluding to, if you're a new trucker and you just got a brand new truck and you're paying a loan on that, you're probably barely getting by at these rates that they're paying at $1.61 a mile when you include the cost to maintain the truck, diesel, etc. And again, I think things are going to get tough out there for the trucking world. They were on top of the world the last couple of years, right? They could charge a lot to move your goods.
Right.
Everyone needed it yesterday. Unfortunately, I feel bad for the sector. They're experiencing a 180 of that right now, and I feel bad for them, to be blunt.
Yeah, that's going to be tough.
All right, I'm going to bring it back now. My last piece is raw research from Bespoke Investment Group. I love these guys because you know what? This is hard data. Okay, this is hard data. So this is
dealing with data, not possibilities, not
this is
forecasts.
Not an opinion. This is raw data. This is from November 12th. Okay, now what I'm about to talk about is the S&P 500 index. I am going to discuss the most correlated periods to the last 12 months of the way the market has acted. What happens going forward? The data set they analyzed, Mark, goes all the way back to 1928. And so I am now going to quote Bespoke. And then in a minute here, Jenna's going to put up this chart here in a second. Are you ready for this?
Hit me.
You sitting down?
I am.
All right, here we go. The 4 most dangerous words in investing, Mark. It's different this time, or this is different this time, it says. And time again, market patterns tend to resemble patterns of the past. Under that premise, we compare the daily closing prices of the S&P 500 over the last year, 252 trading days, to every other one-year window going back to 1928. During that time, there have been 7 other periods where the correlation coefficient between the closing prices and the comparable periods exceeded plus 0.85. And
Right.
those.
And just, sorry, not to, I just wanted to point this out for people. One is perfect correlation, right?
Yes.
-1 is inverse correlation. So just so people have a gauge, 0.85 is pretty damn correlated.
So now Jenna's going to put up this chart for our YouTube visitors. I would highly recommend our traditional podcast listeners go to our show notes on Twitter, LinkedIn, or Facebook to see this. You're going to see this kind of table of data from Bespoke showing those 7 instances. Okay. Just because patterns resemble each other now doesn't mean that the similarities will continue going forward. But until something shakes the market off course, it's good to be cognizant of how things have played out in the past. And I'm still quoting Bespoke here, Mark. Given the high correlation of the prior 7 periods within the last 12 months, it's obvious that the market was weak during each of those periods. Shocker. The range of declines, however, varied widely, with a drop of less than 16% in 1982 period to a loss of over 60% in the year leading up to June of 1932. In the last 12 months, the decline of 16% would rank on the mild side relative to these other 7 periods. Besides the period in August of 2001, which was the month before 9/11, the S&P was higher 3, 6, and 12 months later every time, and in each of those time windows, its median performance was over 10% on each of the gains. Additionally, while there have been 7 periods where the correlation coefficient has been above 0.85 positive, in the 3 periods when the correlation was plus 0.9, so pretty darn close or more, and it shows those, June of 32, January 1975, April of 09, and I've talked about the similarities of March of 09 before for our regular listeners. The S&P was up more than 30% over the next year all 3 times. So you look at this data. This is not an opinion. This is data, factual data. Mark, you get to go first.
Yeah, well, I think it's, the proof's in the pudding here, so to speak, Matt. I mean, it looks like performance going out, even really 1 month, 3 months, 6 months, and 1 year out from, these dates, it's pretty impressive. Only a couple different times where, markets were negative. And, like you mentioned, obviously before September 11th on all 4 of those time frames, the market was negative looking forward, but that was the only one. And again, small sample size, right? So we only have 1, 2, 3, 4, 5, 6, 7 of these dates that were highly correlated, or
just shows you how uncommon a year like this is. Just shows you how uncommon
yeah, it does. But looking at this again, I know N is 7 here, so it's small, but this combined with a lot of other things that we've talked about this year looking forward, Matt, and I know that that's tough for people to do, especially during tough times that we're experiencing right now. Again, it just goes into that pocket that we always talk about, that it's never going to feel comfortable when it is the time to buy.
Absolutely it won't. And I'm just going to say this again. People are overestimating how quick this market could sell off compared to how quick, they're underestimating how quick it can come back.
Right.
And so just as quick as this market has sold off and as bad as the second quarter was, the market has the ability to do the opposite. And that's the point I want to make. I'm going to give the compliance disclaimers here, and I'll say it again from what Bespoke said. Just because patterns resemble each other now doesn't mean the similarities will continue going forward. And on top of it, past performance is not indicative of future results. But the raw data to me is telling me that, there are brighter days ahead here. And once the market starts to move, the easy money is going to get made relatively quick. And this is not a market that you can time. I would be invested for your risk tolerance, your goals and objectives, my words of wisdom, because this market at some point here is going to start to rip. And I think there's going to be a lot of people left at the train station after the train left.
Yeah. Yeah, I agree. And it's just how it always happens, right?
Yep.
So, well, yeah, thank you for that.
Yeah, I thought it would be nice to end on a positive note, because as we've said, the market tends to bottom before Main Street America does. And don't forget that. That's why I keep highlighting 09.
Yep, absolutely. So moving on to the financial planning topic of the week. Recently, 2023 tax brackets, standard deductions, and a couple more items came out, such as IRA contribution limits, 401k contribution limits. So I just want to highlight some of these things for people, Matt. So 2023 tax brackets. If you are single, I'm just going to point out some of the more popular ones that people tend to fall into.
Please, that's good. Yeah.
You're in the 22% tax bracket if you have $44,725 of taxable income, all the way up to $95,375. That's the 22% tax bracket. And then the highest bracket, 37%, is for single people who have $578,125 or more in taxable income. And then again, for married filing joint, $89,450 to $190,750. That puts married filing joint people in the 22% tax bracket. And you have to have above $693,750 of income to be in that top 37% bracket.
Mm-hmm.
The 2023 standard deduction. So for single people, it's $13,850. And for married filing joint, it's $27,700. So went up again this year. And then there's an additional standard deduction for people who have reached age 65 or who are blind. It's $1,500 for each married taxpayer, or $1,850 for unmarried taxpayers. And again, that's the additional standard deduction who are over 65 or who are blind. IRA contribution limits. So the contribution limit for Roth IRAs and traditional IRAs has been increased to $6,500 per year. And the catch-up contribution limit for people age 50 and over does not get inflation adjustments, and therefore is still $1,000. So if you're under 50, $6,500. If you're over 50, that's $7,500.
Yep.
401k, 403bs, and 457s. The contribution limit for those is increased to $22,500 for those under the age of 50. For those over the age of 50, the catch-up contribution has been increased to $7,500. So if you're over 50, you can sock away 30 grand in 2023 toward your 401k.
Fabulous news.
Awesome. And then the maximum possible contribution for defined contribution plan, like a SEP IRA or an owner-only 401k, increased to $66,000 this year.
Great.
Health savings accounts. So for 2023, the max HSA contribution for someone with single coverage under a high deductible health plan is $3,850.
Yep.
And the limit for someone with family coverage under a high deductible health plan is just over $7,700 at $7,750. Again, the HSA catch-up contribution for people age 55 and older is not inflation adjusted, so it remains at $1,000. Capital gains taxes, Matt. Again, just going to highlight a couple. If you're married filing joint, you have a 0% capital gains tax rate if there is less than $89,250 of taxable income.
Goose egg.
Yeah, exactly, which is pretty nice, right? And again, if you're married filing joint, 20% tax rate, capital gains tax rate if taxable income is greater than $553,850.
Nice.
And again, just for single people, you're in the 0% tax rate if you have less than $44,625 taxable income. You're in the top 20% capital gains rate if taxable income is over $492,300. Last two things I have, Matt, before we wrap up. 2023, the annual exclusion for gifts will be $17,000. So what that means, Matt, is any individual can give another individual up to $17,000 per person and not have any consequences for gifting that money.
Yeah.
Right.
Yeah.
So if I wanted to gift money to everybody in my family, I could give 17,000 to my brother Matt. I could give 17,000 to my brother Ryan, 17 to my mom, 17 to my dad, and you won't have any gift tax on that. So it's per person, that limitation.
Yeah, and it won't go against your lifetime gift exemption if you go above that.
Correct.
Yep.
And then lastly, the estate tax exclusion has been increased to 12,920,000 per person. So people are welcome to see that go up because that helps really everybody. So
yeah, I agree.
So that's it for the financial planning topic of the week. Matt, anything else you want to leave listeners with before we end it here for the week?
No, we get the jobs data for November. I believe it's December 2nd. If they're going to have it ready that quick, it would be the first Friday. So that's going to be the next main piece of economic data I think people will be staring at. Light trading on Black Friday. So don't expect a lot of craziness that day. But no, I hope everyone enjoys Turkey Day with their friends and family. And I hope everyone has a great holiday week.
Yeah, me as well. Well said. Well, thanks everybody for tuning in to episode number 177 of the Independent Advisors Podcast. As Matt said, please enjoy this time this week with family and friends. Enjoy football, enjoy the good food, and we'll see everybody next week. Matt is on Ohio State, even with a 7.5 point spread. So we'll come back and follow up to see if he is accurate.
We will see.
All right, everybody, take care.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.